stock markets are fluctuating wildly and uncertainty looms. So what's driving the markets and where do we go from here? Welcome to The Bridge to Knowledge with David Barol. In today's episode, we'll connect the dots between political leadership, consumer confidence, and economic forces like household debt and interest rates to help you make informed investment decisions. Let's make sense of the markets together. Hello everyone and welcome back to The Bridge to Knowledge with David Barol, helping you get from where you are to where you want to go. So I'm your host, David Barol, and today we're tackling one of the most critical topics for investors: how economic and political forces affect the stock market. Why does this matter? Because understanding the relationship between the economy and market performance is key to building a financial strategy that helps ensure growing income you'll never outlive, helping you avoid the risk of living too long. Today, we'll explore how presidential policies, global events, and key metrics like household debt and unemployment drive markets. And of course, we'll tie it into some of those core economic principles from last time, like marginal analysis, confidence intervals, and opportunity costs to help guide your thinking. We're going to get a bit into the weeds on this episode, so grab your coffee, take a nap, and let's dive in. Now hold on there, partner, not so fast. Before we dive in, it's time for our question of the day. Today's question comes from Bill in East Falls, who asks, David, I was thinking of downsizing in a few years, but with the new administration and the threats of foreign wars and the uncertainty over tariffs, I'm now wondering if the housing market is at its peak and I should sell now. What do you think? Well, that's a great question, Bill. Timing the peak of a housing market is tricky, especially during political and geopolitical uncertainty. So here's my take. For what it's worth, market trends. Housing markets are influenced by local dynamics. Is your home in a desirable area with low inventory? If yes, prices may stay strong regardless of what's going on in the external world. As Tip O'Neill once said, all politics is local, and the same applies to real estate. 2, interest rates. Rising rates make mortgages more expensive, which can cool buyer demand and pressure prices downward. If rates stabilize or drop, we might see demand and prices heat up again. So, besides what's going on in the external world, interest rates are going to have a huge impact on what you can sell your house at, all things being equal. 3, sticky prices. When it comes to prices of goods like houses, as well as organized labor, prices go up easier than they go down. This is called sticky prices. Sellers will gladly accept more for a house, but when they don't get their number, they may take the house off the market rather than cut prices. 4, your personal situation. The selling isn't just about timing the market, it's about aligning the sale of your house with your life goals. If downsizing simplifies your life or frees up equity for other priorities, then it may make sense to sell sooner rather than later. 5, confidence intervals. Now think in terms of probabilities rather than certainties. It might be the right time to act if you believe there's a 70% chance the market is near its peak, and that aligns with your goals. You don't have to worry about hitting the precise high point, just as long as you're within the range. Well, thanks for your question, Bill. The key is to have a plan from where you'll move and how you'll allocate the proceeds. Strategic decisions always win out in the long run. So now for the folks at home, if you have a question you wish to address, you can go and submit that question on our website. And while you're there, you can catch up on past episodes and even visit one of our sponsors, if that's something you're ought to do. Let's start our discussion by examining how political leadership shapes consumer confidence, a key driver of market behavior. So number 1, fiscal policy. Tax cuts and government spending boost economic activity, but each decision involves trade-offs, what economists call opportunity costs. Should funds go to infrastructure like investing in high-speed rail or building a better bridge into Mexico, our largest trading partner? Or should Congress offer tax relief to companies that invest in better machinery and equipment to keep U.S. manufacturing competitive on an international scale? Or should Congress vote to transfer funds from one group of people to another group of people, because that is the fair thing to do in the eyes of Congress? So how will these choices affect future growth? That's fiscal policy. Number 2, deregulation policy. Reducing regulatory burdens can lower business costs, fostering growth. However, excessive deregulation carries risks, such as using building materials that can't support the weight of a building or producing products that shatter. Number 3, communication. Leadership isn't just about policy, but it's about setting the right tone. Consistent, optimistic messaging builds trust, while mixed signals erode confidence. Your personal investments depend on many factors, including the stature of the person you just elected to the presidency and other important national leaders. Number 4, crisis management. During crises, decisive action is crucial, whether it's a pandemic, a hurricane, a threat of war, or a financial meltdown. Decisive steps restore stability and confidence. It has been a few years, but when President Carter gave his Crisis of Confidence speech, in which he spoke about the presidency being too big for just one man, or that the age of American greatness was over, he sucked the will and vitality out of the American people, culminating with our failed attempt to rescue the hostages held by Iran. When America overwhelmingly elected Ronald Reagan, he spoke about a new dawn for America, and the hostages came home on the day he was inaugurated. Our stock market went from malaise to optimism too. Coincidence? If political leadership drives consumer confidence, then what does consumer confidence drive? The answer is simple: consumer spending, which in turn drives 70% of the gross domestic product, the GDP, making it the backbone of the economy. But its impact doesn't stop there. It ripples into the stock market, shaping trends, investor sentiment, and even the performance of specific sectors. Let's break this down to see how consumer confidence plays a pivotal role in stock market success. Consumer confidence reflects how the public perceives the health of the economy, their own future financial stability, and the willingness for them to spend or save. When consumer confidence is high, people are more likely to spend money on goods, services, and experiences, which boosts corporate revenues and profits, which in turn attracts more money into the stock market. This optimism translates into high stock prices as investors anticipate sustained profitability. On the other hand, low consumer confidence signals economic uncertainty, causing people to tighten their wallets, which can reduce corporate earnings, negatively impact the stock market performance. So let's examine how consumer confidence affects stock market performance. Number 1, spending and corporate earnings. Consumer confidence directly influences spending, and in a consumer-driven economy like the United States, spending is a primary engine of growth. When confidence is high, discretionary spending rises because people know there's more money to come. Retailers, travel companies, and luxury good manufacturers benefit from this extra spending, reporting stronger revenues that then in turn bolster their stock prices. On the flip side, when confidence falters, these sectors often see significant declines, dragging the broader market down with them. Number 2, investor sentiment and market trends. Consumer confidence also aligns with broader investor sentiment. When consumers are optimistic, investors interpret it as a sign of economic health. They may adopt a bullish outlook, increasing demand for equities and driving up the prices of stocks. Conversely, declining confidence introduces uncertainty, leading to market corrections as investors anticipate weaker corporate earnings. Number 3, sector-specific sensitivities. Now, certain sectors are particularly sensitive to shifts in consumer confidence. For example, retail, travel, entertainment. They all tend to thrive when confidence is high, and when sectors like utilities or healthcare, often viewed as defensive investments, become more attractive during periods of low confidence. Now, the link between consumer confidence and stock market performance isn't just theoretical, it's supported by data. Measures like the Conference Board's Consumer Confidence Index, the CCI, and the University of Michigan's Consumer Sentiment Index, UMCSI, show clear correlations. Here's some historical examples. In the late 1990s, high consumer confidence fueled the dot-com boom, contributing to unprecedented stock market growth. Conversely, during the 2008 financial crisis, consumer confidence plummeted, aligning with a dramatic market decline. Here's some pandemic dynamics. In early 2020, the COVID-19 pandemic caused a sharp drop. In early 2020, the COVID-19 pandemic caused a sharp drop in consumer confidence, leading to a historic market crash. As confidence recovered post-pandemic in 2021 and 2022, the stock market rebounded, particularly in the discretionary sectors like retail and travel. So why does this connection exist? Well, one, the economic multiplier effect. High consumer confidence sets off a chain reaction. Spending increases, corporate revenues grow, and companies reinvest in hiring and expansion. New hires then have money to go ahead and spend and buy, and so on and so forth. It becomes an economic multiplier. This economic growth creates a positive feedback loop, reinforcing stock market gains. Two, investor psychology. Markets are deeply influenced by sentiment. When confidence is high, uncertainty decreases, encouraging investors to take risks. Low confidence, in contrast, creates fear and risk aversion, triggering sell-offs. Now keep in mind these limitations. Consumer confidence is a vital indicator, but it's not the only indicator influencing stock market trends. Other elements like corporate earnings, monetary policy, geopolitical events, all play a critical role. Moreover, the effects of consumer confidence can lag, with markets reacting to immediate events before fully reflecting the broader sentiment shifts. So let's break it down. One, confidence influences spending. Higher consumers' confidence means people are more likely to spend on non-essentials, while low confidence tightens wallets. Measuring consumer confidence helps us predict how spending might shift under various scenarios. Two, investor sentiment. A confident consumer signals economic health, boosting stock prices. Declining confidence does the opposite, leading to market volatility. Three, feedback loops. A rising stock market enhances perceptions of wealth, encouraging spending and further driving up stocks. A cycle of optimism. Conversely, a declining market diminishes confidence, creating a downward spiral. So what's the takeaway? Consumer confidence is a vital link between economic activity and stock market performance, but it doesn't act alone. Other factors like interest rates and corporate earnings all play a role, but consumer confidence is a powerful driver of trends. So if we want to understand where the market is heading, ceteris paribus, all things being equal, we need to keep a close eye on how confident consumers are feeling. It's a reminder of how interconnected our spending habits and the market movements truly are. And now, a word from one of our sponsors.
Today's episode is sponsored by Bala House Publishing, proud to present Dima, A New Hope by Dima Taya and David Barol. Available on Amazon, this compelling nonfiction work shares the extraordinary story of Dima Taya, an Arab Muslim Israeli woman breaking barriers. From appearing on Israeli and Arab television to delivering powerful speeches and running for the Knesset, Dima's journey is a beacon of hope and unity in a divided world. Her story offers a unique perspective on resilience, leadership, and the pursuit of peace. Discover Dima, A New Hope on Amazon or wherever fine books are sold. Bala House Publishing, bringing impactful stories to life. Now, back to the show.
Now let's talk numbers. Economic indicators and geopolitical risks shape the market, but often interact in complex ways. So let's take household debt. At $17 trillion, household debt has grown significantly, since 2016. All else being equal, this reduces disposable income, impacting consumer spending. 2. Unemployment. A 3.8% unemployment rate reflects a strong labor market, but inflation has eroded real wages, leading to labor strikes and demands for higher pay. 3. Geopolitical risks. Conflicts in the Middle East and Eastern Europe elevate volatility, driving investors to safe havens such as gold or treasury bonds. And 4. Volatility. The VIX, or Volatility Index, gauges expected stock market volatility over the next 30 days, derived from S&P 500 options. Often termed the fear gauge, it reflects investor sentiment. Higher values indicate increased market uncertainty. Historically, the VIX has spiked during market turmoil, such as the 2008 financial crisis and the COVID-19 pandemic in 2020. As of December 8th in 2024, the VIX stood at 27.62. Today, in April of 2025, the VIX crossed 57.52. That's more than twice. According to data compiled by Yahoo Finance, 3 straight days of elevated volatility of around 6% or more have only happened 3 times in history: the 1987 market crash, the 2008 financial crisis, and the lows of the pandemic. 5. PE ratio. Historically, the S&P 500's price-to-equity ratio, the PE ratio, has averaged between 15 and 16 times earnings, meaning that the average price across all the stocks in the S&P 500 divided by the profit, the earnings, has been between 15 and 16 times. In December of 2024, the PE ratio peaked above 20 times. Now, elevated ratios suggest higher expectations, but also they signal vulnerability. 4 months later, amidst the brouhaha over the policy decisions of the administration, the S&P 500's price-to-earning ratio fell to approximately 19.98 based on projected earnings for the next 12 months. Now, PE ratios have 2 different factors, right? So we hear about PE ratios, but what they can increase when the price goes up or the earnings go down. So knowing the approximate number and how it's supposed to project what's happening over the next year could be that either the prices are high or the earnings are forecasted to get lower than they are today. So the 19.98 is still higher than the 10-year average of 18.6, suggesting that the market is currently valued a little slightly higher, even with the recent sell-offs. This is according to the Wall Street Journal. Now, just so you know, the PE ratio, along with a lot of these other metrics, can vary depending on who the source is and the methodology they use to calculate these things. And yet, another one of the metrics we look at is earnings growth. So positive earnings trends in financials and industrials hint at economic resilience, while broader contractions will raise red flags as to where the market's going. So as of the beginning of April 2025, the earnings growth landscape for the S&P 500 reflects a mix of recent downward revisions and still some cautious optimism for the remainder of the year. So during the first quarter, at the beginning of the first quarter, analysts were very optimistic and they predicted an increase in earnings of 11.7%. But by the end of the first quarter, these year-over-year earnings growth rate projections were dropped to 7%. That's a significant downward revision. And it's attributed to larger than average cuts in earnings per share estimates across a wide range of sectors. So it's market-wide. Now, out of the 107 S&P 500 companies that have issued earnings per share guidance during the first quarter of the year, 68 out of the 107 were reporting negative reports compared to where they were at the beginning of the year. Now, for the full year, analysts project current earnings rate growth of approximately 9.4% for the entire year, which is still a reduction from 12.5% forecasted early in the year, according to Bloomberg. Now, all 11 sectors in the S&P 500 are anticipated to experience earnings growth in 2025. Right? No one's looking at earnings dropping. It's just that the rate at which they grew has now been recalculated and reset to be lower. Now, the recent implementation of tariffs by President Trump's administration has introduced economic uncertainties, and that leads to market volatility as expressed by the VIX, and also concerns over a potential recession. These factors have prompted analysts to adjust earnings forecasts downward, reflecting apprehensions about the broader economic impact of ongoing trade policies. So in summary, while the S&P 500 is still projected to achieve earnings growth in 2025, recent trends indicate a more cautious outlook, with analysts tempering their earlier optimism due to emerging economic challenges. Finally, let's discuss how interest rates and policies affect markets, especially through the lens of tools we looked at last week, confidence intervals, and marginal analysis. 1. Interest rates, a key driver of market behavior. Interest rates, which are set by the Federal Reserve, are one of the most powerful levers influencing the economy and the stock market. High interest rates curb borrowing and spending, but help control inflation, while low rates encourage borrowing and spending and investment, but can sometimes overheat the economy. Here's how it works. When the Federal Reserve raises rates, borrowing costs increase. Loans for businesses and individuals become more expensive, reducing spending on major purchases like homes, cars, or business expansion. As a result, corporate profits decline. Higher interest rates, expenses, erode company profits, often leading to lower stock prices. Stock valuations fall. Investors typically discount future earnings more heavily when rates are high, reducing stock valuations such as the PE ratio. High PE ratios signal a time to sell. When the Federal Reserve cuts rates, borrowing becomes cheaper. Individuals and businesses find it easier to take loans, spurring economic activity. And corporate earnings improve. Lower interest rates increase profitability, which can drive up stock prices. And market optimism rises. Lower rates often boost investor confidence, encouraging greater investment in equities. So, 2, using confidence intervals to assess market scenarios. Confidence intervals, which we just talked about last time, help investors estimate the potential range of market outcomes under different interest rate scenarios. For example, a 95% confidence interval might suggest that the Federal Reserve raises rates by 0.5%, the S&P 500 could decline between 5 and 8% with a 95% confidence. So we don't know exactly where it's going to be, and taking an average doesn't make much sense. We just know it's going to fall within that range of 5 to 8, 95% of the time. Now, conversely, if rates remain unchanged, the market might have a 70% probability of remaining flat or gaining up to 3%. So by using confidence intervals, investors can make informed decisions about their asset allocation, knowing the range of potential risk and rewards associated with interest rate changes. So here's a practical example. Suppose the Federal Reserve signals a rate hike. Investors might adjust their portfolios. Right? They may shift assets from growth stocks, which are sensitive to rate increases, to value stocks, which are less sensitive. All right? They can assess their probabilities. So if there's a high probability, let's say 80%, of a hike in interest rates, investors might reduce exposure to rate-sensitive assets, such as 10-year bonds. And here's where marginal analysis comes in, balancing costs and benefits. Marginal analysis helps us evaluate the incremental impact of interest rates changes. This tool is crucial for business and investors alike. For example, businesses. A company may analyze whether the marginal cost of borrowing at a higher rate outweighs the benefits of investing in new projects. And for investors, marginal analysis can help determine whether the potential return from equities justifies the increased risk in a high-rate interest environment. So here's a case study. Imagine a business considers taking a $100 loan for expansion that promises a return of $110. At a 2% interest rate, the projected return on investment is 8%, making the expansion highly profitable. At 5% interest rate, the ROI is not as attractive, falling to 5%, which may be below the threshold to make an investment. So, or at best, making it only marginally worthwhile. So, by looking at marginal analysis, it helps your business decide whether the additional cost of borrowing is justified. Similarly, investors use the same thought process to evaluate whether an additional investment in a stock or into the market as a whole is worth the risk. And if bond yields rise due to interest rate hikes, the marginal benefit of shifting from stocks to bonds might outweigh the risk of staying in equities. The feedback loop between rates and market sentiment. Interest rates also influence consumer confidence, creating a feedback loop. Low rates boost confidence. Lower rates signal easier monetary policy, which reassures investors about economic growth. High rates spur caution. Rate hikes can dampen optimism, leading to sell-offs or shifts into defensive assets. Using confidence intervals and marginal analysis, investors can better navigate this dynamic and understand how rate changes affect not only the economy, but also market psychology. So, in conclusion, interest rates act as the economy's thermostat, balancing growth and inflation. Whether rates rise or fall, understanding their impact on borrowing, spending, and market sentiment, consumer confidence, is essential to staying ahead in an ever-changing financial landscape. As we've explored today, understanding the relationship between government policy, world events, the economy, and the stock market is critical for building financial security. You can confidently make better decisions and navigate uncertainty by applying the economic concepts of confidence intervals, opportunity costs, and marginal analysis to public policy, to investments, to confidence, consumer confidence, and to see how it will affect your life. So thank you for joining me on today's The Bridge to Knowledge podcast. Please like, subscribe, and share the podcast. Tell all your friends. And if you have a question for a future episode, submit it via the link in our show notes or on our website. I'm David Burrell, helping you get from where you are to where you want to go. I'll see you next time.
David Burrell is the principal of Keystone Asset Management Strategies. He holds multiple securities registrations and investment licenses, including Series 7 General Securities Representative, Series 24 Securities Principal, Series 53 Municipal Securities Principal, Series 63 Uniform Securities Agent State Law, and Series 65 Investment Advisor Representative. He also holds the following professional designations: Certified Financial Planner, CFP, Chartered Life Underwriter, CLU, Chartered Financial Consultant, CHFC, Behavioral Finance Advisor, BFA. David earned his undergraduate degree from the University of Virginia and a master's in public policy from the Kennedy School at Harvard University. Securities and advisory services offered through Creative One Securities LLC, member FINRA SIPC, and an investment advisor. Keystone Asset Management Strategies and Creative One Securities LLC are not affiliated.